System isn't designed to help you build wealth. It is designed to take it the moment you do. Think of your financial life as a bucket. You spend 40 years trying to fill this bucket. You grind at your job, you start a side hustle, you invest. You are obsessed with the inflow. You watch the water level rise and you feel safe. But here is what you do not see. While you are staring at the top of the bucket, the system is drilling invisible holes in the bottom. There is a tax hole, a lawsuit hole, a creditor hole, a divorce hole. The terrifying reality is that the more water you pour in, the faster it drains out. An analysis of asset seizure data and bankruptcy filings shows a brutal pattern. The average person who builds significant wealth will lose a massive portion of it to systemic extraction before they die. They don't lose it because of bad investments. They lose it because they never learned the rules of the protection system. The wealthy know something you don't. They know that earning money is only phase 1. Phase 2 is defending it. Today, we are going to dismantle the myth of ownership. We are going to expose the invisible infrastructure the top 1% uses to seal their bucket. We are going to talk about why owning things in your own name is the single most dangerous financial mistake you are making. By the end of this, you are going to understand the philosophy that separates the rich from the middle class. Own nothing, control everything. This is not about evasion. It is about understanding that the law was written by people who wanted to protect their assets, and if you read the rules closely, you can use the exact same walls they built. The visibility trap. When you start making money, your biology works against you. You want to see your name on things, on the deed to your house, on the business license. It feels like validation. But that pride is the bait. In this country, your assets are legally exposed by default. That means creditors, lawsuits, the IRS, and opportunistic lawyers can see your bucket. And because your name is stamped on it, they know exactly where to drill. Lawyers don't sue broke people. They sue people with assets. If you have a rental property in your name and a tenant slips, they aren't just suing the property. They are suing you. They are coming for your personal house, your car, your child's college savings. Because your name connects everything, one vibration collapses the entire house of cards. The wealthy do not have this pride of ownership. They have the pride of this control. If you own it, it can be taken from you. If you control it, but a separate legal entity owns it, it is protected. This is the own nothing philosophy. The billionaire you see on Forbes, he doesn't own that yacht. A trust owns an LLC, which owns a holding company, which owns the yacht. He just controls the trust. He is a ghost. And because he owns nothing, he is bulletproof. To build this fortress, we first need to identify the 4 main tunnels the system uses to drain your wealth. Tunnel 1. The tax escalator. As your income climbs, the tax brackets climb with you. But here is the trick. Income is taxed heavily. Ownership is taxed lightly. If you earn a salary, you are a W-2 employee. You are the highest taxed entity in the economic food chain. The money comes to you, the government takes its cut immediately, and you spend what is left. But if you control a legal entity, like an LLC, the flow changes. The money comes to the business. The business spends money on expenses, cars, technology, home offices, using pre-tax dollars. Then and only then does the government tax what is left. The wealthy don't earn paychecks. They own structures that generate distributions. Tunnel 2. The lawsuit magnet. We live in the most litigious society in history. If you have visible wealth, you are a target. Let's look at 2 investors, Marcus and Sarah. Marcus owns a duplex in his own name. A pipe bursts, ruining a tenant's electronics. The tenant sues Marcus personally. The judgment is for $100,000. Marcus has to liquidate his personal stock portfolio to pay it. He is ruined because his asset was attached to his identity. Sarah owns the exact same duplex. But the deed says, Blue Horizon Holdings, LLC. When the tenant sues, they have to sue the LLC. Sarah's personal house? Safely behind a wall. Her stocks? Untouchable. The lawsuit hits a firewall. Tunnel 3. The creditor vacuum. If your business fails, or you default on a loan, creditors have immense power. They can freeze accounts and seize property. But the wealthy use a tool called charging order protection. If your assets are held in the right type of LLC in the right state, like Wyoming or Nevada, a creditor cannot seize the assets inside the company. All the court can give them is a charging order, which says, if Sarah ever decides to pay herself a profit, you get the money. But Sarah is the manager. She controls the distributions. She can legally decide not to distribute profit that year. The creditor gets nothing. This creates a legal stalemate. Most creditors look at that wall and walk away. Tunnel 4. The divorce drain. 50% of marriages end in divorce. In most states, anything you own personally is marital property. The wealthy don't wait for the marriage to fall apart. They build walls before they say, I do. Assets held in irrevocable trusts created before the marriage are often excluded from the split. The trust owns the business, not the spouse. The blueprint, building the machine. We know the traps. Now let's build the machine. Stop picturing a bank account. Start picturing a castle. Level 1, the operating company, the pawn. This is where the risk happens. This entity interacts with the public. It signs contracts. It hires employees. If something blows up, it blows up here. The key. This company should own nothing. It should have very little cash. It leases its equipment. It is a shell designed to absorb impact. Level 2, the holding company, the rook. This is the vault. It does not do business with the public. Its only job is to own things. The holding company owns the intellectual property, the heavy equipment, the real estate. Then it leases those assets down to the operating company. Why? Separation of church and state. If the operating company gets sued, the lawyer looks inside and sees leased computers. They can't touch the holding company because the holding company didn't do anything wrong. Level 3, the trust, the queen. This is the invisibility cloak. The holding company isn't owned by you personally. It is owned by a trust. When you look up public records, you don't see your name. You see the Jupiter Trust. You control the rules of the trust, but you do not technically own the assets. The strategy: borrow until you die. You might be thinking, if I don't own it, how do I spend the money? This is where the tax code cracks open. This is the buy, borrow, die strategy. The wealthy do not sell assets to pay for their lifestyle. Selling triggers a taxable event, capital gains. That is friction. Instead, they borrow against the assets. Let's say your holding company owns $5 million in real estate. You don't sell it. You go to a bank and ask for a $200,000 line of credit secured by the assets. The bank gives you the cash. Debt is not income. The IRS does not tax borrowed money. You just accessed $200,000 tax-free to fund your lifestyle. How to start sealing your bucket. You are not a billionaire yet. You might think this is overkill. That is the comfort trap talking. You cannot build a bunker while the bombs are falling. You build it while the sky is clear. Here is the step-by-step path, regardless of where you start. Step 1. Separate risk from assets. Look at your life. Do you have a side hustle, a rental? That is risk. Do you have savings? That is an asset. Never let them meet. Get an LLC for your side hustle immediately. Do not run as a sole proprietor. A sole proprietorship is a legal suicide pact that pledges everything you own to satisfy a mistake. Step 2. Compartmentalize with single asset LLCs. If you buy real estate, do not put 3 properties in one LLC. That is putting all your eggs in one basket. If a tenant sues at property A, they can take property B. Use series LLCs or separate entities for each property. Build watertight doors. If the ship takes on water in one compartment, the rest stays afloat. Step 3. Jurisdictional arbitrage. Shop for the best laws. You don't have to form your entity in the state where you live. If you live in California or New York, the laws are hostile to asset protection. States like Wyoming, Nevada, and South Dakota have built economies around protecting wealth. They have strong charging order protections and anonymity. The wealthy ask, "Where are the laws best?" and move their paper existence there. Step 4. The umbrella policy. Before expensive lawyers, buy insurance. An umbrella policy is the cheapest defense you will ever buy. For a few $100s, you get millions in extra coverage. Think of insurance as the moat. Think of the legal structure as the castle walls. You need both. Step 5. The trust layer. Once you have significant assets, move them into an irrevocable trust. This is the hardest psychological hurdle because you legally give up ownership. But remember, the trust agreement is the rulebook. You wrote the rulebook. You are the architect. You just aren't the owner. When you achieve this, you become a ghost. Predators can't find you. Bonus step: debt recycling. Most people try to be debt-free. The rich try to be free of bad debt. If you have a business, you can restructure your cash flow. Use business income to pay down personal debt, which isn't deductible. Then, borrow through the business to pay for expenses, which is deductible. You swap a liability that costs you money for one that saves you taxes. You are recycling debt from bad to good. Conclusion: chess versus checkers. Why go through this trouble? Because the default setting of the system is extraction. The default is for you to work until you die, pay taxes on every dollar, carry all the risk, and leave nothing behind. The system relies on your ignorance. It relies on the fraud visibility trap. Your ego wanting to own things. The top 1% owns 30% of the wealth but pays a fraction of the taxes relative to growth. They are sued, but they don't lose their fortunes. We are going to keep breaking down these legal cheat codes and the psychology that keeps people poor. Don't just build wealth, bulletproof it.